Acceleron Learning, life experience accelerated. On deck right now, financial literacy and the structure of a loan. Hi, and thanks for joining us. I'm Amanda Maisie. Loans are a key component of personal and business life, allowing you to obtain goods and provide for business growth and liquidity. Money lending is as old as recorded human history, dating back to at least 9,000 years ago. The first clearly documented rules for fair lending practices are found in the Judeo-Christian Bible. But what is a loan exactly? Loans are transactions made between a borrower, who can be an individual or a business, and a lender, which can be a financial institution such as a bank or an individual. Usually, the borrower requires a loan because there is a purchase or other immediate financial need for which the borrower does not have sufficient liquidity. Liquidity is another word for funds that are accessible and available to meet regular operating requirements. The amount of money that is borrowed is called principal. For providing the money to the borrower, the lender will charge a fee called interest. The loan is an obligation of the borrower to the lender and requires repayment over some agreed-upon period of time. However, there is more to a loan than the amount of the down payment and the monthly amount of the payment on the note. Borrowing money is something almost everyone will do in a lifetime, and some more frequently than others. Applying for a loan can be an exercise in information asymmetry. So what exactly does that mean? Well, it means that you are at a disadvantage when you are taking out a loan. Unless the loan is provided by a friend or a family member, you are dealing with a professional money lender who knows much more about the process than you do, since you're the occasional borrower. All of the talk of interest, fees, repayment, and amortization schedules, terms, and conditions can seem like mumbo-jumbo, especially to the first-time borrowers. But remember, words certainly have meaning. Some points to remember about the loan process: you are committing a portion of your monthly income or business cash flow for a specified period of time. You are paying a premium or interest for the ability to have something now rather than when you have the funds saved to make that purchase. You are signing a contract promising to make a series of payments over time, and a contract may still be valid long after the item you purchased has been used up. So before contracting for a loan, ask yourself some questions. Would you want to have 4 years remaining on a 10-year car note for a used car with 250,000 miles on it? Would you want to take out a 2-year loan in order to finance a 1-week vacation? So why are these questions important? When there is a discrepancy in time between the benefit received and the length of time remaining in the loan, the likelihood of default increases. In other words, it's risky for a lender to give you lots of money for something with a very limited benefit. Always remember to keep that balance between needs and wants. And remember that wants tend to fade, but loan payments are forever. At least they seem that way. Loans have several fundamental characteristics. The most important is the principal amount of the loan, which is how much you are actually borrowing. Since this money costs you money in the form of interest, never borrow more than is necessary to make your purchase. Interest is the cost of borrowing money. The total amount of interest paid is expressed as a dollar amount and represents the cost of borrowing. The interest rate is expressed as a percentage and is determined by the lending source. This rate will be a function of several variables, such as the amount and length of the loan, the borrower's credit worthiness, and the general economic climate. The frequency of payments is the number and timing of payments made in a year. The standard frequency is once a month, but sometimes payments may be scheduled weekly. Frequency of payments has a natural impact on the number of required payments and is calculated by multiplying the number of payments per year by the number of years of that loan. The payment date is the day of the month that the payment is due. This is very important to remember, as payments after that date can result in additional late fees. The maturity date, well, that's my personal favorite. This is the date the final payment is due and the loan is paid in full. Collateral is the underlying asset that secures the note, such as a car or a house, but not all loans require collateral. An amortization schedule is often provided to borrowers. If it's not provided, be sure to request one, as this schedule is a summary of all of the above components of the loan payment. Specifically, the schedule is a summary of the contractually agreed upon repayment schedule and the details the amount of the principal and the interest repaid by each payment. The amortization schedule will also detail the number of payments, the amount of interest paid each year, and the date of the final payment. Now, did you know that in the past, people often had mortgage burning parties? That's right. Once that last house payment was made, homeowners often invited the neighbors to witness the mortgage burning, meaning they would literally set fire to the now fully paid note in honor of their status as true homeowners. Of course, this required staying in that house for 30 years, and just don't burn that note before it's all paid off. The concept of interest has different meanings depending on whether one is the lender or the borrower. To the lender, interest amount is a total return or profit in dollars earned by providing a loan. To the borrower, interest amount is the total cost in dollars of borrowing money. The interest rate is expressed as a percentage and serves as the basis for calculating the interest amount. For example, $100,000 borrowed for 1 year at an interest rate of 5% will cost the borrower $5,000 and will provide $5,000 in profit to the lender. Interest rates are determined with an eye towards risk. Simply stated, the lender will analyze a loan application using the potential borrower's credit score, income and length of employment, and collateral offered. Then they will incorporate observations about the general market conditions and the potential profit to the lender. Finally, they will develop an appropriate rate for that loan under those conditions. The interest amount, or the dollars spent on the cost of borrowing, can be calculated in different ways. The example of a 1-year, $100,000 loan at a rate of 5% is an example of a simple interest calculation in which interest is calculated only against the outstanding principal. However, some loans may involve compound interest. This is not an issue with a fixed rate, fixed payment, fixed term loan for the obvious reason that all the variables are unchanging. But what about credit cards, sometimes known as revolving credit? These types of loans do not have a payment amount, fixed amount, or a fixed loan amount. If the amount borrowed and the cash amount of interest charged can vary, the borrower may be paying compound interest. Compound interest occurs when interest is added to the principal, so that from that moment on, the interest that has been added also itself earns interest for the lender. This addition of interest to the principal is called compounding. A bank account, for example, may have its interest compounded every year. In this case, an account with $1,000 initial principal and 20% interest per year would have a balance of $1,200 at the end of the first year, $1,440 at the end of the second year, and so on. This is a great deal for lenders and also for investors, but not so great for borrowers. They will often be paying more in actual interest amount than they realize. In order to compare interest rates to one another, the interest rate and the compounding frequency must be disclosed. Since most people prefer to think of rates as a yearly percentage, many governments require financial institutions to disclose the equivalent yearly compounded interest rate on deposits or advances. This equivalent yearly rate may be referred to as annual percentage rate, or APR. Remember then that a true comparison of rates must compare apples to apples, or APR to APR. Let's talk a little more about collateral. A loan with collateral is also called a secured loan, and that means the lender has the right to take possession of assets offered as collateral if the loan is not paid. Examples of secured loans are mortgage loans, which are secured by the home purchased, and automobile loans, which are secured by the vehicle purchased. Sometimes business loans may be secured loans. For instance, a business loan that is secured by assets of the business and/or personal guarantees of the business owner or officers, or personal loans which can be collateralized by stocks or other assets owned by the borrower. In contrast, contracting for an unsecured loan means that no collateral is offered by the borrower. Instead, the loan decision is based solely on the creditworthiness of the borrower. Interest rates on unsecured loans are likely to be higher than the rates charged on a secure loan because the lender is accepting more risk. We know that a loan payment involves both principal and interest, but when a borrower makes a monthly payment on a loan, how is that payment allocated? The payment allocation is outlined on the statement, which is the statement that shows how the payment is applied to both principal and interest for each payment period. Generally, payment allocation will follow this schedule closely if all payments are made on time. However, if you make a payment late, the interest will continue to accrue based on the principal outstanding, meaning the interest portion of the loan will increase, but the principal portion will not decrease. So a larger portion of your payment is applied to interest owed, and your outstanding principal is not reduced as much as it would have been. Plus, interest amounts will be higher in subsequent months because the principal outstanding is now somewhat higher. So a practical tip is to make your payments before they are due. The amount you pay will be the same, but the earlier payment will reduce your interest cost. More of your payment will be applied to the principal, and your loan will be paid off faster. So why does it work this way? Because interest represents the cost of using someone else's money. Paying a little early reduces the amount of time you have that money, and in turn reduces the amount you pay in interest costs. Let's talk a little more about the connection between interest rates and credit scores. Your credit score is used as an indicator of how risky it is to lend money to you. The relationship between credit scores and interest rates are inverse, meaning the lower your score, the higher the interest rate, because interest is compensation to the lender for risk of a principal loss. This is called, appropriately enough, credit risk. Credit scores fall into three general categories of excellent, good, or poor, with numbers assigned to each category. Borrowers in the excellent category can expect to pay the lowest interest rates as credit risk is expected to be low, so lenders demand less in compensation. Borrowers in the poor category will pay the highest rates as credit risk is expected to be high, and lenders will demand the highest compensation for taking this risk. The ability to obtain credit will have significant impact on your life, so it pays to monitor your credit scores. We've talked about interest costs and interest amounts. Let's talk a little more about the types of interest rates. A fixed interest rate is exactly what it sounds like. A rate is quoted and it stays the same throughout the entire life of the loan. A variable interest rate is also what it sounds like. The rate will change based on an underlying criterion such as published financial index. Variable rates may be attractive because they typically allow for a lower initial monthly payments, which can make the initial loan payments more affordable, but the borrower is assuming the risk of interest rate changes in the future, and often those rates can increase to an amount that makes the loan no longer affordable. The annual percentage rate is comprised of the interest charged on the loan plus the cost of any fees associated with originating that loan. This rate represents the true cost associated with a loan. Knowledge of the APR allows a borrower to compare loans on a consistent basis, and disclosure is required by law. So if your lender does not tell you the APR, always remember to ask. By way of comparison, the annual percentage yield, or the APY, also called the effective annual rate, is a normalized representation of an interest rate based on a compounding period of 1 year. Knowing the APY allows for a single point comparison of different investment offerings with varying compounding schedules. APY does not account for the possibility of account fees affecting the net gain, and APY refers to the rate paid to a depositor by a financial institution. APR, on the other hand, refers to the rate paid to a financial institution by a borrower. Next, we'll take a look at the number and frequency of payments.